Let's connect then with Sandip Sabharwal as well, who's joining in on the show. And Sandip, let's get in a sense from you as to how you're looking at the market momentum, given the fact that we've seen support coming in from all quarters. And yesterday as well was a pretty steady day of trade. FIIs continuing with the buying spree. Where to from here?
It's a tough thing to predict simply because of the fact that suddenly FIs have turned huge buyers at while being sellers at lower levels, and yesterday's buy figure was very huge. So it also could reflect some unwinding of short positions which would have been taken in the offshore markets and got reflected in the cash market trades yesterday. Now the valuations are becoming higher and higher, and that's the challenge which we as investors face because now the existing portfolio is continuing to do well, but I don't get the confidence to deploy huge additional money at these valuations.
Okay, fair enough. What about your outlook then in terms of the IT sector? Because that has clearly been at the forefront. Do you believe that the traction here within IT across the board will continue even in the second half?
The IT companies have done very well since the first quarter results when the entire philosophy became that the growth seems to be bottoming out, and from here on we'll see improvements. The movements as predicted by the most of the IT companies was maybe 1 or 2% in the last quarter results, and most stocks have already rallied 20 to 30%. So I would think that a majority of the upside because of the improved prospects is already in the price. Now, for further improvement in stock prices, we will need another significant improve in growth outlook, which prior to the presidential elections in the US looks tough. So I think for most of these companies, then the next quarter results updates will become more important. But from an absolute point, a return point of view, it looks tough for the most of the companies in the sector to do anything significant from there.
Sandeep, what's the take when it comes to the entire realty space? An interesting note coming in from CLSA today saying that for DLF they expect EBITDA and cash flows to grow higher, and that the NCR market as well is looking very promising. Given the kind of trajectory, the kind of demand and pricing that we've seen, is real estate looking like a promising pack?
All real estate stocks have already performed. If you see how these stocks have done over the last 4 5 years, especially post COVID, the returns across the board have been exceptional. Now, the point is that whether this kind of growth momentum can sustain. Some of the real estate companies now seem to be indicating that further price increases at least will not be possible because now the supplies have started to come in. So earlier there was a time when supplies were restricted because the projects take time to start and then actually get ready. Now, huge number of projects are coming up across the country. Now, real estate is from here on, it's not such a easy task to predict what's going to happen uh, because of the fact that valuations are high and demand could taper off if the credit growth in the financial system continues to moderate in line with what RBI has predicted or trying to do, that your credit growth should be in line with your deposit growth because the entire real estate market is actually funded out of loans. So, so I think that's the challenge the real estate sector could face next year. The cash flows and balance sheets of most of the real estate companies continue to be strong, and I think that's a positive. I would think that it's something you buy on corrections of maybe at least 15%, not at these valuations.
Well, Zomato at 283. It is just that in last 1.5 years, that 2 has got added ahead of Zomato. 2 years ago, I think it was at 83. Indian Hotel at 700. It is just that a 0 has got added in last couple of years. In the COVID crisis, it had plunged to 70. Now that is what the market is all about. Extreme fear and extreme excitement. I won't use the word greed and euphoria because companies are still growing. But that is the positioning of the market right now. Sandeep, let me put a template here, which is that macros have suddenly turned favorable for India on the crude front, on the liquidity front, and again on the dollar index front, which is that foreign institutional investors, when they look at India or when they look at any other emerging market, they look at crude, they look at macros, they look at interest rates, and then they make a view, and then they decide which stock to buy. On that front, do you think Indian markets now are on the cusp of getting a lot of flows from foreign institutional investors? Because typically I've seen, Sandeep, a lot of macro allocators who are country allocators, they look at macros before they look at micros.
So that's something which is also reflected in the recent FI flow numbers, which were continuously negative earlier when the valuations actually were more reasonable, and now they've suddenly turned positive. So I think many of these factors do drive money into emerging markets. But then, and we also see huge inflows into mutual funds. But then we were more buyers when the markets were cheaper. So just because they are funds flow, you don't go and buy stocks at any valuation because markets have their own way of correcting when they become too heavy, etc. So, like we discussed last week, so I don't think we are looking for a big crash in the markets, but I think, in my view, the current valuations are high almost across the board. So we should keep some cash on the sidelines and wait for the appropriate opportunities. What will generate those opportunities is tough to say. Maybe it will be disappointment in what the Fed does or what the outlook is next week or any global event.
Sandeep, what about the outlook on the traditional defenses that have really been proving their might? A lot of these FMCG counters or pharma for that matter have been at the forefront over these past few weeks. Is there more to go?
So I think given the valuations at which markets have reached, there's a high probability defenses might outperform as the markets stall uh, going forward, which they should. The same pace of upside is very tough to maintain. Now, the key for the performance of these companies from here on absolute terms, how much percentage gain they can give will also depend on the actual volume recovery and what actually has been the impact of in, good monsoons, etc., improve sentiments on rural urban demand for the products of these companies. The initial upmove in these stocks has been led by the consumer stocks, has been FMCG ones, has been led by the forecast by these companies that things are going to improve. Now, whether things are actually improving will be reflected as the results come out and as the festival season starts. I would be inclined to be positive for the large consumer companies, but then the absolute performance will depend on how volumes improve.
Just curious to get in your take, Sandeep, as to what your outlook is on a lot of these crude related counters. With the kind of movement that we've seen in crude oil prices, what do you believe is looking like a very lucrative opportunity for the long haul?
See, many companies benefit due to lower crude prices. The input, like the traditional ones, which I believe are paints, or the OMCs, etc. Aviation is a direct beneficiary. Auto companies should be beneficiaries, but the rate cuts are not being passed through, so they don't benefit actually. They could actually benefit if the fuel prices get cut because it creates a positive sentiment at a time when these companies have to give discounts for the sales to move. So the best direct beneficiary continues to be Interglobe Aviation, which is also benefiting due to reduced competitive intensity. The stock continues to do well, and there's no reason why I think it will not do well going forward also.
Sandeep, but this entire crude trade, I don't know how convincing it is. I mean, okay, on paper it has come down to $70, but it has to stay at $70 for a long period of time before the benefits could kick in. I mean, Indigo may get lucky 1 day, 2 day. So A, crude has to stay below these levels. B, all the other factors like demand and other vectors also have to be in play. So do you think somewhere this drop in crude, long commodity producer trade is slightly overstretched?
The crude prices and most commodity prices have been on a downturn for some time now. So most of the commodities saw an upside earlier part of this year in the expectation of demand revival, which actually has not happened globally. So and there is so much excess capacity in crude now, and with a huge number of LNG gas projects coming on stream next 2 3 years, because of that also the overall crude and oil and gas basket will remain subdued. So I think it's going to be a good 2 3 year phase unless and until something very significantly negative happens geopolitically. From the consumer standpoint, next 2 3 years with the normal volatility which we see in these commodities should be fine for the consumers.
I'm Sandeep. Let's also find out what exactly your outlook is on all that's played out with Z Entertainment, the roller coaster ride that we've seen the stock as well go through. Is this a complete write-off?
Yes, it should be because of the fact that the traditional TV viewing has been coming off, and on the OTT front, their venture is sort of stillborn. Like they are there, but they are not really there. So the combination with Sony would have made them financially stronger, and but I don't think that exists now. So I think it will be a stock which might continue to languish here or around these levels for a long, long time.
So, Sandeep, if FIs are back, which it appears, and the macro tailwinds are strong the way they are on the crude front, on the interest rate front, on the dollar front, on the emerging market front, then are we in for this compulsive selling in private banks getting over? Because if that happens, then we could be looking at a different market, because HDFC Bank, ICICI Bank, if they chip in, then we are looking at this market really getting an engine effect.
And because what usually happens at these times is that we don't find reasons why market should correct because of the fact that everything looks good. So I think markets are in that scenario. Private sector banks have not participated as much the entire banking segment in the recent past simply because of the fact that fundamentally there are reasons for that. Lower credit growth, lower margins, potential increase in NPAs from next year onwards. So I think those things will remain. But I think the quality franchises will need to participate if the markets continue to trend up. So if we are to say that markets will continue to move up, then most of the private sector banks will start to participate. Most of the large banks, ICICI, Axis, Kotak, HDFC, all have to start to participate if the markets are going to hold up.
But Sandeep, if the private banks do make a catch up and they do participate in the other sector rally which is currently at play, would you be tempted at booking some profits?
So if the markets continue to move up higher, then I think we will from the current levels of 12-15%, I think which we should maintain. If the valuation become more unsustainable, then we increase cash further rather than try to deploy it.
Okay. And this is specifically for banks or across the board?
In general, for the portfolio as a whole, now
Got
which
it.
company you need to book out or which you want to hold, it will depend on relative valuations.
What is your portfolio looking like? Have your top 3 holdings or top 5 holdings changed?
Not significantly, I think last not much of changes. Last we added when some mid caps like SHK and all we added at lower levels, which have also rallied now. So not buying them right now. So looking to add some of the older holdings where results were not so good, like Ahluwalia contracts where outlook is good, but last quarter results are bad. So I think it's down 20% from the top. So looking to buy into that if it dips further.
Okay, interesting. Ahluwalia contracts, if there is a further dip in the stock, is what Sandeep is keeping on his radar. But Sandeep, always good having you on the show. We'll let you go on that note.
If you like this video, then like, share and subscribe to ET Now.